How to legally hire your toddler to fund a custodial Roth IRA. This is the strategy that allows parents who own a business to put their young children on payroll, pay them for legitimate work, and deposit that income into a custodial Roth IRA in the child's name. The math behind it is extraordinary, and the rules that make it legal are specific. A custodial Roth IRA is a Roth IRA opened in a minor's name, managed by a parent or guardian as custodian, until the child reaches the age of majority. That age is 18 in most states and 21 in others, at which point control of the account transfers automatically and irrevocably to the child. The money belongs to the child from the moment it is deposited. Even while a parent manages the investments, they cannot take the funds back. The IRS requires one thing for a Roth IRA contribution: earned income. There is no minimum age. A child of any age, including an infant who appears in commercial work, can contribute to a Roth IRA, provided they have documented earned income. The contribution limit is the lesser of the annual IRA limit or the child's total earned income for the year. For 2026, the IRA contribution limit is $7,500. The connection to hiring a young child runs through family business ownership. When a parent owns a business, the IRS permits them to hire their own children as legitimate employees, provided the work is real, age-appropriate, and compensated at market rate. Here is where the strategy gets creative but stays legal. A 5-year-old appearing in photographs for a family photography business can be compensated as a child model. A young child helping to hand out flyers, sort mail, or perform simple tasks that are genuinely necessary to a business can be paid a reasonable wage for that work. The IRS does not prohibit hiring your children. It requires that the work be legitimate and the pay be reasonable for the job performed. A 12-year-old who maintains a family business's social media presence, appears in product photos, or performs office tasks that would otherwise require hiring an outside person is performing genuine work. The compensation for that work constitutes earned income, which qualifies for a Roth IRA contribution. Documentation is the element that separates a legitimate strategy from a red flag. The IRS scrutinizes arrangements involving very young children working for family businesses, and the audit risk is real. Every payment to a child employee needs to be backed by records showing what work was performed, when, how much was paid, and at what rate. That means job descriptions, time logs, written descriptions of tasks completed, and actual payments made through payroll, not cash given without a paper trail. The pay rate should reflect what an outside hire would receive for the same work, not a made-up number designed to maximize the Roth contribution. If the child's earnings are reported on a W-2 or on a self-employment tax return, and if the payments are genuine and documented, the IRS has no grounds to disallow them. The strategy works because the rules are followed, not because they are bent. The tax benefit for the business is also significant. A legitimate wage paid to a child employee is a deductible business expense for the business owner. That wage reduces the business's taxable income while simultaneously creating earned income for the child that can be deposited into a Roth IRA. In many cases, children earn below the standard deduction threshold, meaning the income is not taxable to the child at all. The business gets the deduction, the child gets a retirement account, and the tax on that income is zero at the child's level. The power of this strategy becomes clear through the math of compound growth. A Roth IRA opened for a 5-year-old with even modest annual contributions has more than 55 years to grow before that child reaches retirement age. At an average market return, contributions made in childhood can grow into sums that dwarf anything that same person could accumulate starting in their 30s or 40s. The money grows tax-free inside the Roth IRA the entire time. When the child eventually withdraws in retirement, It comes out tax-free as well. No taxes on the way in at the child's level in many cases, no taxes on the decades of growth, and no taxes on the distributions. The entire chain from earned income to retirement withdrawal can be structured with little or no tax at any stage. Once the child reaches the age of majority, the custodial account converts to a standard Roth IRA fully under their control. From that point forward, the account is theirs to manage, contribute to, invest within, and eventually withdraw from under the standard Roth IRA rules. The parent who set up the account retains no claim to the funds, cannot redirect them, and cannot reverse the decision to fund the account. It is an irrevocable gift that compounds tax-free for the rest of the child's life. For business owners with minor children, this is one of the most efficient long-term tax strategies available. The requirements are real work, documented pay, and a paper trail that holds up to scrutiny. Follow those rules and the IRS has nothing to object to. The part that makes how to legally hire your toddler to fund a custodial Roth IRA so important is that the headline usually sounds simpler than the reality. A retirement account rule can look like a clean yes or no decision from the outside, but inside the account there are layers. Who owns the asset? Where the money came from? How the IRS classifies the transaction? And whether the paperwork matches the economic reality. The people who get hurt are usually not trying to cheat the system. They are usually assuming that a familiar personal finance rule works the same way inside a tax-advantaged account. And that assumption is where the danger begins. A useful way to understand how to legally hire your toddler to fund a custodial Roth IRA is to separate opportunity from control. The opportunity is the tax advantage, the legal structure, or the extra flexibility the rule creates. The control is what you must give up to keep that advantage intact. Inside retirement accounts, you often gain tax treatment by accepting restrictions on access, timing, ownership, documentation, or personal benefit. When someone focuses only on the upside and ignores the restrictions, the strategy stops being a tool and becomes a trap. The first practical question is always ownership. Who legally owns the money, the asset, the account, or the benefit at the exact moment the transaction happens? In normal life, people think in practical terms. I paid for it, I manage it, therefore it is mine. The retirement account world is different. The account can be the legal owner, even when you are the person making decisions. That distinction matters because a tax break is often attached to the account, not to you personally. If the ownership line gets blurred, the IRS can treat the transaction as if the tax shelter was broken. The second practical question is timing. Many tax rules are not just about what you do, but when you do it. A transaction that is harmless in 1 year can be expensive in another. A withdrawal that is clean after a waiting period can be taxable before the waiting period ends. A conversion, contribution, distribution, sale, rollover, or account transfer can all create different outcomes depending on the calendar. This is why dates, tax years, account opening years, and transaction records matter more than most people expect. The third practical question is money flow. Every dollar should have a clean path. Where did it start? Where did it go? And what account touched it along the way? Problems appear when personal money and retirement money cross paths without a clear reason. Problems also appear when income that belongs inside an account is deposited personally or when an expense that belongs to the account is paid out of pocket. Even when the dollar amount is small, the pattern can signal that the account and the owner are not being treated as separate financial entities. Documentation is not decoration in these strategies. It is the evidence that the transaction happened the way the strategy requires. Statements, custodial forms, plan documents, tax forms, written approvals, purchase agreements, beneficiary records, conversion confirmations, and distribution records are the paper trail that turns a story into proof. If the records are missing or inconsistent, the taxpayer may still believe they followed the rule, but proving it later becomes much harder. In a dispute, memory is weak, documents are stronger. Consider two investors looking at how to legally hire your toddler to fund a custodial Roth IRA. The first investor asks only one question: how much money can this save me? The second investor asks a different set of questions: what rule creates the benefit? What would disqualify it? What records prove compliance? And what happens if my situation changes? The first investor may move faster, but the second investor is less likely to create an expensive surprise. Most sophisticated financial planning is not about finding the flashiest move. It is about knowing which details keep the move from backfiring. The emotional trap is urgency. People often hear about a loophole, deadline, exception, account feature, or tax advantage and feel as if they need to act immediately before the chance disappears. Urgency is useful when it motivates research, but dangerous when it replaces research. The right response is to slow the decision down just enough to map the rule. What is allowed? What is prohibited? What is uncertain? What professional should review it? A strategy that cannot survive careful questions is not a strategy worth rushing into. Another overlooked risk is assuming that a platform, custodian, employer, broker, or online form will stop you from making a mistake. Financial institutions are often responsible for processing instructions, not for guaranteeing that the instruction is optimal for your taxes. A button may allow a transfer, a custodian may process a distribution, a plan may permit a contribution. That does not automatically mean the tax result is the one you wanted. The taxpayer is usually the person left explaining the transaction when tax season arrives. The cleanest way to approach how to legally hire your toddler to fund a custodial Roth IRA is to build a checklist before money moves. Identify the account involved, identify the rule being used, identify the tax form that may be created, identify the deadline or holding period, identify who is allowed to benefit, identify what would make the transaction taxable or penalized, then decide whether the potential benefit is large enough to justify the complexity. This kind of checklist does not make the strategy exciting, but it makes it usable. There is also a difference between legal and practical. Something can be permitted by the tax code and still be a poor fit for a person who does not want administrative complexity. Something can be available inside a retirement account and still be inappropriate if it creates liquidity problems, record-keeping problems, or concentration risk. The best strategy is not the one with the most impressive headline. The best strategy is the one a person can execute correctly, maintain consistently, and explain clearly if anyone asks. The deeper lesson behind how to legally hire your toddler to fund a custodial Roth IRA is that tax-free or tax-advantaged does not mean rule-free. It means the government is offering a benefit in exchange for staying inside a defined structure. The benefit can be powerful, but the structure is not optional. Once you understand that, the entire subject becomes less mysterious. You stop asking, "Can I get away with this?" You start asking, "What exact conditions make this work, and can I meet them without creating a new problem?" Before making a move, the safest habit is to write down the intended result in plain English. Then compare that intention with the mechanics. If the goal is tax-free growth, does the money actually remain inside the account? If the goal is avoiding a penalty, has the relevant clock actually finished? If the goal is protecting an asset, is the title or beneficiary record correct? If the goal is using a deduction or credit, do the income limits and documentation support it? Clear intention plus clean mechanics is where good planning lives.